Hello traders, Gary Wagner here, just about 10:10 in Honolulu, 4:10 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. 3rd day of June, 2016, and this is the Daily Report for Gold and Silver. Dismal, absolutely dismal jobs report surfacing today, gyrating many of the markets, some of them with expected knee-jerk reactions, and some of them more muted unless you understand the dynamics behind it. I'm speaking about the equities markets. But precious metals, specifically gold, off like a banshee, a rocket moving into the sky. We're trading up about $33 on the day, closing at $1246.30. It traded to a low last night before the report was released of a 1209, and we're sitting on the highs right now. 1246.90 is the high of the day, current print 1246.30. Absolutely no doubt an incredible stellar move in the precious metals, specifically gold, closing up almost 3% on the day, 1246. This is what I'm looking at currently in terms of our Elliott wave count, as well as my upside market forecast at this point. It was very, very difficult to have an utter read because we had this high here and then we had our higher high at about 1300, but we certainly cannot assume that this move from about 1200 up here was a full wave. It would have absolutely been a truncated wave. And so what we have now is something called an irregular ABC correction. What I mean by that is I believe that we hit the top of our wave one here. There we went into our correction, our A, our B, and our final C. Now it is this B that makes it an irregular because the B, of course, is above the top or the highs that were achieved on wave one. That's why it's called an irregular ABC correction. That being said, and this move moving us well up and above any kind of former level of support that we needed to see held, and it is obvious that we have absolutely concluded. We had a 3 count on the way down, our B to C, 1, 2, 3. That completed our C, which completed our 2, our second wave here, which means we are moving into a wave 3. Wave 3 cannot be the smallest of any of the impulse waves. So now let's do a forecast forward study to look at wave 1 in relation to where wave 3 could go. And so traders, here's where it gets really interesting. All I have done is created a basic fib extension. The extension begins at 1047, going all the way up to the top of what we're calling our wave 1, which comes in right here, as you can see. From there, we basically start our extension from the conclusion or beginning of wave 3, conclusion of wave 2, which comes in here, call it 1200. When we do that, here's the numbers that we come up with. If wave 3, and it really shouldn't, but if it was only a 61% extension of wave 1, that would take us to 1344. If we get a 1-to-1 relationship, meaning wave 1 is equal to wave 3, we could see the market move as high as 1436. This is just basic Elliott wave forecasting, and if in fact this model holds true, we could be in for a multi-month rally. Interesting move in silver. We have the same kind of a upside surge, up 2.67% at 1639. That is where the market closed, the high 1654. So we're looking at a weekly chart standard candlestick format of silver. Silver also spectacular move, up 2.66%, closing well above $16 per ounce at approximately 1640. Now, when we look at this chart, there were a couple of things we talked about. First of all, I had been sidelined looking at silver because of this tremendous sell-off, even in the light of gold not performing nearly as bad. But we also pointed out throughout the week that this was a pretty critical area, the 1600, and that was based upon this former top that we had. It should be a good support area. It certainly was, even though the market dipped within it. Piercing line on our weekly candlesticks is what we've identified, and that is going to complete really the incomplete dark cloud cover that was identified at the top, followed by the confirming candle, and then the subsequent 2 weeks of sell-off. I think we will see silver firming along with gold over the next month, month and a half at least. So the jobs report that came out this morning pointed to the fact that there were less new jobs added, I believe 38,000, and that is the lowest number of new jobs added on a monthly basis since 2010. Of course, that really squashes the idea that this month the Fed, when it meets, will actually do that rate hike, the anticipated interest rate hike. Therefore, we had all of the premium move back into gold, and as you can see, out of the US dollar. Dollar closing off over 1.5%, 1.66 at 93.97. So how much lower could the dollar go? Well, based upon our technical studies, and we're looking at a daily chart, you can see the devastation. This is today's candle, giving up a tremendous amount of premium that really came into the market as that expected rate hike was really the prevalent thought amongst traders. Remember that it was just at the beginning of May last month that we saw the dollar go to an intraday low below 92, 91.99, I believe. It whipped off of that with a fury and then moved up to almost 96 on a closing basis, but we certainly saw a couple of highs touch in that moment. Now, we have this area 93.80. It's a pretty hardcore area. It's where we've been calculating a lot of our fib studies from, and that's based upon this bottom, of course, to this top here, which covered the range. We dipped well below that, and so my sense right now is if this particular price point, meaning 93.80, doesn't hold, we probably could come back and test the areas of 93 and 92 on the dollar index. So once the jobs report came out, tremendous spike to the upside, precious metals, tremendous move to the downside, US dollar. Now, with the type of news we had, you would think on the surface at least that that would be a foreboding sign in terms of US equities markets. Now, Dow Jones Industrial Average did close off today, but it only closed off by 0.16%, a 31% drop, negligible in the big picture. Same with the Standard & Poor's. One plausible explanation for the supportive action we have seen in the equities markets in light of that dismal jobs report is the fact that as that dollar loses value, it makes these U.S. equities more globally attractive to not only multinational companies, but multinational investors, investors from outside the United States. And so, as we look at the Dow, it was able to maintain much of the gains that we have seen, the majority of the gains. Same thing with the Standard & Poor's. Standard & Poor's closing just a few ticks shy of 2,100 to close at 2098. Absolutely no doubt an incredible ending to an interesting week in the markets, the most dismal jobs report in the last 6 years. Of course, all the premium that came out of gold as we saw gold prices drop from 1306 down to an intraday low of 1199 have come flooding back into the market. US dollar under tremendous pressure. That's supportive of the equities markets, which didn't drop nearly as much as it could have with that kind of a jobs report. We will look next week for higher pricing absolutely in gold. I think we're looking at the beginning of a multi-week rally. I would expect the dollar to continue under pressure and equities to flirt with those record highs, but they've still been unable to break above resistance. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.